I had started investing when I was 11. I just dithered away until when I was 7 and 8 and 9. So unfortunately, I didn't get started until I was 11. But I bought my first stock when I was 11, and then I experimented with a whole bunch of things, the timing of stocks and charting and doing all these crazy things. It was a lot of fun. Profitless, but a lot of fun.
Did you know that according to a study by the National Endowment for Financial Education, only 24% of millennials demonstrate basic financial literacy? This number is both scary and surprising in a world full of economic problems and chances. It shows how important it is to make smart financial choices and investments. Now imagine Warren Buffett, one of the greatest investors of our time, addressing this gap. He says, "The best investment you can make is in yourself." This powerful statement sets the stage for our exploration of the top investments recommended by Buffett to secure your financial future and never worry about money again. In the light of the shocking fact that millennials do not know much about money,
We've both had a fair amount of experience in real estate, and Charlie made his early money in real estate. The second point is the more important point. Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time.
it is important to look into real investment strategies that can help close this knowledge gap. One of the most effective methods, as emphasized by Warren Buffett, is investing in real estate for income. Let us look at why this is not only a good way to invest your money, but also a key part of getting rich over time. Real estate investment is a big help in generating passive income. According to a report by the U.S. Census Bureau, the median rental income in the United States was $1,483 per month in 2021. This steady cash flow is a key attraction of real estate investing, offering a more predictable income stream compared to the often volatile stock market. Historically, real estate has shown consistent appreciation. Information from the Federal Reserve Economic Data, or FRED, indicates that the average annual home price growth from 1968 to 2009 was 5.4%. This appreciation, combined with rental income, contributes to the overall return on investment in real estate. Real estate allows investors to use leverage effectively. For instance, with a 20% down payment, you can control a property worth 5 times your initial investment. This leverage can amplify returns significantly. But you need to be careful when using leverage because it can also make losses bigger. Real estate offers several tax advantages. The IRS allows deductions for mortgage interest, property taxes, operating expenses, and depreciation. These benefits can reduce taxable income from rental properties, enhancing overall profitability. For example, depreciation alone can shield a significant portion of rental income from taxes, depending on the property's value and the depreciation schedule. While real estate is lucrative, it's not risk-free. Vacancy rates, for instance, can impact income. The U.S. average vacancy rate was around 6.8% in Q4 of 2020, as per Statista. To lower these risks, you need to have good property management and market research. Real estate investment is a long-term strategy. It's all about gradual wealth accumulation rather than quick gains. The combination of rental income, appreciation, and tax benefits makes it a robust investment choice. But it requires patience, research, and a commitment to long-term goals. Expanding on the concept of real estate as a lucrative investment avenue, it's important to understand the various ways that one can generate income and build wealth through real estate. Each method offers unique opportunities and works for different investment styles and goals. Number 1 is rental income. The most direct way to make money in real estate is through rental income. As a landlord, you earn money by leasing your property to tenants. According to the National Association of Realtors, the median rent price in the U.S. increased by nearly 10% from 2020 to 2021. This steady stream of income can be a reliable source of cash flow and can increase over time as rental rates rise. Number 2 is property appreciation. Real estate typically appreciates in value over time. This appreciation can result in a significant profit when selling the property. The S&P Case-Shiller U.S. National Home Price Index shows an average annual home price appreciation of around 3 to 5% nationally, which can be higher in rapidly growing markets. Number 3 is flipping properties. Buying properties, renovating them, and selling them for profit, known as flipping, is another way to make money in real estate. This method requires a good understanding of the real estate market, renovation costs, and the timing. According to ATT-OM Data Solutions, home flippers saw an average gross profit of $67,000 per flip in 2020. Number 4 is real estate investment trusts, or REITs. For those who prefer a more hands-off approach, investing in REITs is an option. REITs are companies that own, operate, or finance income-producing real estate. They offer the advantage of real estate investment without the need to direct buy property. As per the National Association of Real Estate Investment Trusts, the average annual return of REITs over the past 20 years has been about 10.5%. Number 5 is real estate crowdfunding. Real estate crowdfunding platforms allow investors to pool their money to invest in larger real estate projects. This method offers access to larger, potentially more lucrative real estate deals with relatively smaller individual investments. According to a report by Transparency Market Research, the global real estate crowdfunding market is expected to grow significantly, offering diverse opportunities for investors. Number 6 is commercial real estate. Investing in commercial real estate, such as office buildings, retail spaces, or warehouses, can offer higher rental income potential compared to residential properties. The commercial real estate market has its own dynamics, with returns often tied to the health of the economy and specific industries. In a nutshell, real estate offers a variety of ways to make money, each with its own set of risks plus rewards. Whether it's through rental income, property appreciation, flipping, REITs, crowdfunding, or commercial investments, real estate remains a versatile and potentially lucrative avenue for building wealth. As always, successful real estate investing requires research, due diligence, and a clear understanding of your investment goals and risk tolerance. After we have looked at the various ways to generate income from real estate, it is time to turn our attention to another important area of investment that Warren Buffett strongly supports: investing in businesses for growth. This strategy is not just about earning income, but about tapping into the potential for substantial value appreciation over time.
That a stock is part of a business. I mean, you can't think of a stock as something different. You value a business, and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol.
Investing in the stock market offers access to a wide range of established companies. Buffett's approach here is to identify businesses with strong fundamentals and a clear path to growth. He looks for companies with a competitive advantage, strong management teams, and a proven track record of profitability. For instance, the S&P 500, a benchmark index, has historically returned about 7 to 10% annually on average, showcasing the growth potential of investing in established companies. Venturing into startups presents a riskier, yet potentially more rewarding path. Startups offer the chance to invest in innovative ideas and emerging markets. While the risk of failure is higher, with statistics indicating that about 90% of startups fail, the rewards for investing in such a successful startup can be substantial. Early investors in companies like Amazon or Google, for instance, saw exponential returns on their investments. Buffett emphasizes investing in companies that are at the forefront of innovation. This could mean technology firms developing new software, biotech companies working on groundbreaking medical treatments, or renewable energy companies pioneering sustainable solutions. The key is to find businesses that are not only growing, but also driving change in their industries. Buffett's strategy is rooted in value investing, buying stocks that are undervalued relative to their intrinsic worth. This approach requires thorough research and a long-term perspective. It's about understanding the business, its market position, and its growth prospects, rather than focusing on short-term market trends. While focusing on growth, it's important to diversify your business investments. This means not putting all of your money into one sector or one type of company. Diversification can help to reduce risks and smooth out the volatility inherent in business investments. Investing in businesses for growth requires patience and discipline. It's about resisting the urge to react to short-term market fluctuations and staying focused on the long-term potential of your investments. Buffett himself is known for this patient approach, often holding on to his investments for decades. Now you know about the real estate and business investments. It's time to think about another real investment strategy that goes well with these. Diversification is still an important part of a strong investment portfolio. But let us look at another strategy that fits with Warren Buffett's ideas about smart investing. A key strategy that aligns with Buffett's investment philosophy is investing in index funds. Unlike picking individual stocks or sectors, index funds offer a way to invest in the broad market segment or the entire market. This method spreads investments across a lot of different assets, which is really what diversification is all about. Buffett has often advocated for index funds, especially for individual investors. The reason is their simplicity, cost-effectiveness, and broad market exposure they offer. For instance, an S&P 500 index fund invests in the 500 largest U.S. companies, encompassing various sectors. This not only spreads risk, but also taps into the growth potential of the entire market. Historically, index funds have provided solid returns. Over the long term, the S&P 500 index, for example, as I said earlier, has delivered an average annual return of 7 to 10%. This makes index funds an attractive option for those seeking steady growth without the need to actively manage their investments. One of the biggest advantages of index funds is their low expense ratios. Because they are passively managed, tracking a specific index rather than trying to outperform the market, their management costs are significantly lower than actively managed funds. Index funds are particularly well suited for long-term investing. They offer a way to participate in the economic growth of a country or a specific sector over time. This aligns with Buffett's philosophy of buying and holding rather than trying to time the market. While index funds are generally less risky than individual stock investments, they are not immune to market volatility. However, the fact that they are diversified helps lower this risk, which makes them a more stable long-term investment choice. To sum up, index fund investing is a practical and successful tactic that adheres to Warren Buffett's investment philosophies. It offers simplicity, diversification, and the potential for steady growth, making it an excellent addition to a well-rounded investment portfolio. By incorporating index funds into your investment strategy, you can achieve a balance of risk and return, paving the way for a more secure financial future. Adding to Buffett's wisdom, the fourth top investment is yourself. This means investing in your education, skills, and personal development. It's about gaining knowledge, improving your abilities, and staying adaptable in a rapidly changing world. Investing in yourself can lead to better career opportunities, higher earnings, and a more fulfilling life. As we wrap up, remember Warren Buffett's words: anything that improves your own talents, nobody can tax it or take it away from you. Whether it's real estate, businesses, diversification, or personal growth, the key is to start now. If you make these investments, you will probably not have to worry about money again in the future. Remember, the journey to financial freedom starts with a single step, and that step is yours to take.